The reason we've been able to raise even more money, triple in size over the last 5 years, which is arguably the worst time to invest, was our transparency and our value-add approach. We're seeing right now in 2026 many deals coming to us of people who bought in 2021, but they did not have our value-add approach. So they'd buy a $10 million property and they'd just cross their fingers and they'd say, well, 5 years later, real estate's always worth more. If we buy an asset right now for $6 million that should be worth $10 million, we're not projecting what we think the market will be in 4 years. We're buying an asset that right now should be worth $10 million. And so we're fixing it up and force appreciating it. Not only is it long-term, but also we're force appreciating things, which helps mitigate the risk.
Something that people don't realize about passive real estate investing until they're already in is that it is passive. The benefit of passive real estate investing is that you're able to pool your money together with operators, with other investors, and people that have experience to purchase larger assets, so you're getting the scales of economy. You get quarterly distributions, so the only time you should really hear about the asset is every quarter you're receiving an update and you're receiving a check, and that's it.
At LeavenWealth, the investor relationship is something we really take pride in. We host numerous meetings to engage our investor base to make sure that, one, not only are we transparent about our business plan and how it's going and how we perceive that might change, we want to make sure we're communicating transparently. So we keep those links open with our investor base. We know and understand that they're more than just capital. They are our partners in business. As we go through this, we want to make sure that they understand the ways that we all make money together, the ways that the market might shift, and ultimately we want their opinion of some of the solutions that we see creatively. You want to be associated with a sponsor who knows and understands the market and is able to dynamically respond and react to what the market is doing. Because markets change, real estate changes. That's one thing that we've seen dramatically happen in the last 5 years. In fact, just recently, we had a quarterly meeting with our investors where we engaged them on that level. We talked about potential solutions and how the market is changing and leveraged their opinions in how we changed course to make sure that we're still providing those investor returns and that we're still executing a business plan where they're making money, where their capital is safe and secure. We differ from other syndications in that we involve our investors a little bit more in the process, and I don't mean that they have to work, but we make sure that we're giving very transparent financials, that we're communicating regularly, and that they have an open door policy with us and can communicate questions with us. We differ from other syndications in that the lion's share of the distribution waterfall goes to our investors after a capital transaction as well. We want to make sure that our investors are rewarded for investing with us because we know this is your hard-earned capital as an investor.
We invest in the Midwest. The Midwest is incredibly stable. You look back to 2008, 2009, you look at areas like Phoenix or the coasts, they had 50% market declines. Well, the worst we saw was just a flattening, just a non-increase, but there was no decrease. And even now, I would say that the economy's in a weird spot. We are still able to find assets in which we can add value to, and we're still able to force appreciate these assets. There's still opportunities. When you're getting into markets where you're purchasing real estate and the rents are at $700, $800 a month and they haven't been fixed up for years, maybe decades, there is still what they like to call meat on the bone for us to go in, improve the assets, improve our residents' lives, and actually improve the overall property following our business plan to create new valuations on the asset.
I think what makes us unique holistically is that we're able to implement value-add approaches that many operators are, but not just a few from this operator that they use or a few from this operator they use. We use all of them. We also manage a large majority, about 85% of our own assets, meaning our own in-house property management company manages the asset. And that's a huge benefit because we can be a lot more nimble with our decisions, that we're not flipping apartments. What we're doing is we're in it for the long haul. That mitigates our risk, but it keeps the investor in. When we take this ride with an investor, we're taking it with them forever. They are a partner, they're receiving all the write-offs, they're receiving the upside, and we're doing this together long term. The most exciting time for me is after a full cycle. After an investor who's been receiving quarterly distributions receives their original capital back on a refinance, it's extremely rewarding to me, not only because we proved the business plan, but when you hand a $100,000 investor $60,000, $70,000, $100,000 back and they still own the property, almost always the next question is, when's the next investment? They have most, if not all of their money back in their pocket. They still own the asset, and now they can recycle those funds so that same $100,000 owns even more assets. It's common in my space to pin the stock market against real estate, and never is that something I've wanted to do. So the real question is, most people have money in the stock market. The question for them is, are you ready to diversify? Are you ready to perhaps build wealth in a different location? Because it's all about buckets. There's the real estate bucket, there's the stock market bucket, maybe there's liquid cash bucket, maybe there's monthly cash flow and liquid lendings bucket.
You don't have to become a landlord to build wealth through real estate. Most syndications give you the deal, we give you the relationship.
You should be working hard for your money, and you should make sure your money is working hard for you.
So if you're interested in real estate, set up a call with us at LeavenWealth and let's talk about how to build that passive income for your future. We want potential investors to feel comfortable with who we are, to build rapport and trust with us before making a decision.